So hello and thanks for joining us for tonight's Australian Repatriation Tax Planning webinar. I'm Julie Kelly, the Sales and Marketing Manager for SMATS Group. I'd like to welcome our presenter tonight, Steve Douglas, SMATS Group's Executive Chairman. Hi Steve.
Hi Julie, hi everybody.
So just before we kick off, if you do have any questions, please feel free to type them into the chat room and we will have an opportunity towards the end of the presentation to answer them. So over to you, Steve.
Okay, hopefully you can just see my PowerPoint screen now. Thanks very much for joining us. We've got a great audience tonight, which is fantastic. And obviously it's very relevant in these times. COVID is certainly mucking everybody around significantly. And a lot of people who had not been planning on going back to Australia to live for quite some time have had, unfortunately, by no reason of their own, maybe their situation changed that they're now having to bring forward that relocation. So we've obviously been helping a lot of people. There's been a lot of redundancies out there, particularly in aviation and hospitality. We've been doing all we can. We've got lots of videos on screen and on the website for you. And this one will be going up on the website soon after as well. We're going to cover a lot of things tonight, including the tax implications of going back and how to minimise your tax when you are back in Australia. It's a very, very big and complicated topic. So I'm obviously trying to give you the key bits that are relevant to you. And and then we're there to give you personal support and guidance all the time. So we'll get stuck into it. We always have to start off with a disclaimer. Obviously this is general information. You make sure that you get singular professional support if you want to make any decisions of your own. To get straight in, I'm just going to assume the fact that hopefully you've read my book, The Aussie Expat, The Luckiest Person on Earth, and have been doing everything you should have been doing as an expatriate while you're overseas, which is primarily acquiring property along the way, building up tax losses and saving as much as you can. So hopefully you've done that and achieved a bit of savings and achieved a bit of a property position. But when you come back, everything changes. You move away from places like Hong Kong that are very tax advantaged, places like the Middle East that are super tax advantaged, and you head back towards a tax structure that is very, very aggressive, certainly by perception, but not necessarily by reality. So we're going to walk you through that tonight. The first thing, I suppose, is the worst thing, and the thing that scares most people is the fact that Australia does tax on worldwide gains and income. Now, that doesn't necessarily mean that you're going to be smashed, but it just means you must declare. There's no way not to declare things. You have to put them in, you have to declare, and therefore you need to give thought to every transaction that you do. Importantly, if you've got any savings built up from your time abroad, they're never going to be subject to tax. As long as you can prove they're from a legitimate source, the sale of an asset, genuine savings on salary, etc. The movement of money back and forth from Australia is not subject to tax. You would have to declare any income that investment capital earns. So if you had a bank account, for instance, in Hong Kong that earns a little bit of interest, you'd have to declare that in Australia from the date of arrival onwards, but you're not taxed on the actual capital itself. You would have to worry about any pensions that you might have had whilst overseas. You've generally got 6 months to roll that over or cash out without any tax impact. And after that, it starts to get some sort of tax either in the superannuation or full personal tax environment. So you need to consider that. And of late, the tax office has been quite mischievous in rewriting the rule book in regards to some pensions. And what they've done is they've pulled out some 1966 law and said that basically if your pension allows you to access it before retirement age, they may not treat it for Australian tax purposes as a pension fund. So we've seen things like the Cathay Pilots Fund, Singapore CPF, Hong Kong MPF, things there that allow you to cash out, may not be getting the same concession. So you really need to talk to us if you've got some pensions before you go back, and we can talk to you about some strategies there. Very complicated matter, so give us a call. If you've got any international trusts, they will not give you much protection if you go back to Australia. They're going to be very visible. Australia has some very strong anti-avoidance rules, foreign corporations, foreign investment funds, control foreign corporation rules, and that will allow the Australian government to tax those as if they were in Australia in many cases, particularly if they're just shell companies. So don't be thinking that an offshore vehicle is the right vehicle for you. Check with us and make sure that it's okay. If it's a genuine operating asset, such as a business that you may have set up overseas, that should be okay. But again, best to check because there's some nasty rules there. Anything that you bought whilst being overseas, such as property in Hong Kong or wherever you may live, any business assets, any shares, anything like that, they all need to be valued, including things like art. So you need to get a sworn valuation from an appropriate licensed valuer. Now, you obviously want to have as high a valuation point as possible, because that is where your new taxing point will be in Australia. You won't be taxed on prior gains, but you'll be taxed on everything above that valuation. So you generally want to get a very, very optimistic valuation, but it just has to come from a licensed qualified valuer in the country of jurisdiction. If you've had Australian shares and overseas shares, they will also become taxable, but again, only on profits after the day of arrival. Now, that would have been a bad thing if you were going back in March and April when the stock market had just shifted down 20–30%, but many of the markets have now recovered, so the current price isn't so bad. You're hoping to go back on a high price day, and that's because, again, only future profits would be subject to tax, past profits not. And once you've been back in Australia more than 12 months, that future profit, half would be tax-free under the capital gains tax rules. One of the big differences between living in Australia and living overseas is that you cannot afford to hope things will be okay. You have to take every financial transaction with full thought and advice. So you need to really consider what's going on. In particular, when you go home, we want to look at the use of structures, and we'll talk a bit more about superannuation trusts and companies later. And indeed, who is going to receive that income? In a place like Hong Kong, if you've got interest earned in your main salary earner's name, that's not an issue because interest is generally not subject to tax. But in Australia, if you have interest in a joint account, it's going to go half to the main salary and half to the non-salary person. And that would be a disaster if they're paying 47%. It would have been far better to have it in the person's name that was not working, where they've got a $20,000 tax-free allowance and don't pay any tax on that earning. So we want to make sure that we've got the income in the right places, individually or through structures. And we also have to manage debt very, very carefully. Again, when you're overseas, you generally will have income coming in to support that debt. If it's deductible, it's a good debt. If it's non-deductible, as I'll show you shortly, it's a bad debt. So we have to be very careful to make sure we only reduce private bad debt, and I'll show you the importance of that in a moment. Just to give you a quick refresher on what you're going back to in Australia, the tax rates are better than they used to be. They're still not flash, and certainly compared to Hong Kong's 15%, they're not overly attractive on the face of it, but they're certainly better than the good old days. And the good old days was when I started my accounting career back in 1985, and the tax rate then was 60 cents in the dollar if your income was over $60,000. Now, at least the top tax rate doesn't kick in until $180,000 presently, and moving up to $200,000 in a couple of years' time. Now we've got still high rates, but your first 18,000 tax-free, your next 25,000 only at 19%, and then you're going to be moving into a 32.5 bracket, and currently there's also a 37% bracket. You also have to factor in Medicare levy once you earn over about $50,000, and that's going to be about 2% of whatever your income is as well. So they're the rates that you've got to look forward to. Now, high rates doesn't mean high tax, because don't forget, it's what is taxable in Australia that matters. But what we do need to do is try and structure our income streams so that they're as tax advantaged as possible. And some of the key ways to do that are things like generating income through a capital gain rather than an income or a profit. One of the reasons for that is capital gains is automatically half tax-free for Australian residents if you've owned the asset more than 12 months. So you're far better to, for instance, buy in and buy out of an asset, realise the profit and only pay tax on half of it, than have a pure profit or interest, flow. So that's something to consider. You want to have some capital gains in your investment pool. Also, property is very tax advantaged. It comes with significant depreciation allowances. And that can usually mean that up to a quarter of your income could be effectively tax-free. So that's something to consider. Look for newish property with the depreciation allowances. And of course, we've got very good retirement tax incentives in Australia. First and foremost, superannuation, which of course can generate tax-free pensions if it's coming from a fully taxed source. And of course, now we also have franking credits on dividends of Australian companies, which come with a 30 cents in the dollar tax credit, which is usually more than enough to offset the tax on the dividend and leave some left over to reduce other tax on things like interest, or if there's some rentals or overseas income, whatever the case. So we want to have a mix of all of these tax advantaged incomes, coupled with try to minimize the income sources, to make sure that we're not pushing too high up those personal tax rates. Now, I just want to highlight a very important element, and one of the key bits of advice we always give our clients whilst overseas is that you want to be saving up as much as you can in order to be low debt or no debt on your family home when you go back. Now, I don't mind if we've got lots and lots of debt on income producing assets, and one of the reasons for that is the after-tax effective rate. Now, you can see here there's two areas, a private loan and an investment loan. And the private loan is if you had it on your home renovation, vehicle, holiday. Now, the way the tax office determines what the loan is simply where the money went when the bank gave it to you. It's got nothing to do with where the security lies or what you want to call it or anything else. It's purely as simple as when you were handed the check, where did you do it? So if you got a check, from a home loan on a property that was an investment property, but used it to renovate your future home, that's a future home loan. It's not the investment property loan. You've got to be very careful here. Now you can see effectively if the interest rate from the bank was 4% per annum, and if hypothetically you were on the top tax rate at 47 cents on the dollar, the truth is you would actually have an additional 3.5% cost in order to pay the tax before you paid the bank. So if you can imagine a 7.5% cost less 47% that you have to give to the bank, that's a very high cost. So it's not a real 4% cost. The true cost of salary required money, income required, is 7.5%. If you'd earned $100, you've only got $53 left to pay the bank that equivalent of 4%. On the flip side, if that loan was for income producing purposes, share purchases, rental income property, business acquisition, any other purpose at all that had some level of income production, that same 4% would be flipped in reverse. Instead of it having to gross up for the tax payable, you would be getting a tax deduction against your income of that same 47%. That would work out in this case at 1.9%, meaning that your tax adjusted effective rate is actually 2.1%. The same loan, the same interest rate, the same everything, the only difference being use of funds. If used for private purposes, 7.5, if used for investment, 2.1. And hence at 2.1, we're happy to carry investment debt even into retirement because it's a low cost that you could go and hopefully generate a higher return to easily cover that. Whereas if you look at the private cost of 7.5% effective, that's a very high cost, and you're going to have to generate a high income to be able to support that. The less private debt, the more investment debt you have, the better off you are. So that's literally what we want to try and achieve. In terms of one of the big things a lot of people ask me is how should I allocate my money when I get back to Australia? And this is a very simple rule that I've always had. And the first one, number one use of your money is reduce private debt, simply because of the slide before. Let's get rid of that higher effective rate cost and move it into lower investment debt. You also want to buy any of the private assets. Pay cash for your car. Pay, if you want to buy a boat, if you want to renovate the house, if you want to get some new furniture, pay cash for anything that is a private asset. And then work out how much of a slush fund you want to keep. Some people want 10,000, some people want 100,000, some people want hundreds of thousands. So whatever it is that you feel comfortable as your cash, leave that to the side, and then consider whether or not to put anything after those three into superannuation. Now we'll talk about superannuation in more detail later, but importantly, it is number 4 on the list, not number 1. A lot of people get mistakenly advised that, hey, put money into superannuation first because it's going to be tax-free in the future. That's all well and good, but you're in a much, much worse position if you've got a lot of money in super and a lot of money in debt on your private home. You're far better to be debt-free on your home with no superannuation if that was the situation. And ironically, if that was your only situation, you'd fully qualify for the pension and the government would give you meal money. Now that's not the preferred, but it's certainly a better scenario than being high debt personal, high superannuation. You want to extinguish private debt first. Anything left over after your superannuation contribution, and that does have limits, as we'll discuss later, then that's what you look for investable. And then last on the list is helping the kids. Now, many people put the kids way up high too. I don't. I'm there to help them, but only after I've helped myself. Some of the best advice I've ever had is those things called aeroplanes, which are now a relic of the past. We can't even use them anymore. But every time I've hopped on an airplane in the past, they start doing the safety briefing and they say, put your mask on before your children. And I believe that's great financial advice too. Keep yourself awake. Don't worry about the kids. If you're awake, they'll be all right. If we're having a look now at superannuation and structures, when you go back, well, superannuation is definitely an important part of relocating back to Australia. Yeah, but just remember, it is just regulated savings. It's not any different or better than normal savings. It's regulated, and therefore there's some tax incentives, but it comes with terms and conditions. So obviously it's tax-free in Australia if you can get it in there. So it's definitely worth considering. There's nothing better than tax-free income. But what you've got to consider is, when do you need the funds? If you are 45, putting money into superannuation now is not a very good option, because you won't be able to access it until about 60 years old. Now that's a long time to wait for meals. So you've got to be careful not to be too super-centric. You know, look after yourself, consider when you need the funds, and keep enough outside of super until you're nearing retirement age before you start loading it up too fast. As I mentioned earlier, pay off debt rather than top up your super balance if it's private debt, and be mindful there is caps to what you can put in. Basically, you can put 100,000 per annum in as non-deductible, but what you can do is put that in a 3-year block. So you can do, you know, in 1 year you can do up to 300,000, but you won't be able to put any more in for another 3 years' time than you could do another 3-year block, depending on your age. In the same breath, you could put 25,000 per annum as a tax-deductible contribution, but you would only do that if you had a higher taxable income. You know, putting more money into your super if you don't have that taxable income doesn't help you, because a superannuation contribution can't make a carry forward loss or an annual loss any larger. So you wouldn't be, you know, claiming it unless you had that income stream. But certainly if you're working, certainly if you've got more, you know, revenue from investments than you need for living costs, then you would be considering putting money in a super until you hit retirement age. And there's also a cap of about 1.8 million plus indexation along the way that you can get tax-free revenue from. If you've got more in your super fund than that per person, then you won't be able to get that portion of the extra tax-free. So you want to have a look and see if you're getting up to those caps, you know, and you'll see how you go. In regards to companies, they're definitely worth considering, you know, and the advantage of them is they have a lower tax rate. You know, at the moment, if it's investment, it's about 30%. The tax rate is theoretically going to move down towards 25%. Again, COVID could change a lot of things with tax rates. Let's see how it goes. But one of the downsides with companies is that there's no capital gains tax discount. You might recall I mentioned that if you own an asset more than 12 months, it's half tax-free. So if the company tax rate is 25 to 30 cents on the dollar and the personal tax rate is 47, if it's a capital gain, half of 47 is an effective rate of 23.5, which is lower than the company rate. So you don't want to be too obsessed with having income, capital gains, you know, growth assets in a company, but it's certainly worth considering, particularly if you've got income overflow. The best vehicle generally from an investment perspective is a family trust or a discretionary trust, and purely because of the fact that it offers flexibility. It can distribute to whoever's going to pay the least tax. It can indeed distribute to a company owned by any beneficiary and take advantage of those lower tax rates of the corporation as well. So it gives you the best of all worlds, and usually that is the best vehicle to hold your assets when you go back to Australia. Now, having said that, it's unlikely that you would transfer any major assets that you held. Certainly if you had any Australian property in your name when you go home, you wouldn't transfer from your personal name to the trust. And the main reason for that is it would trigger stamp duty, and it would also trigger capital gains tax, which may be an unwelcome cost. So you have to look at everything on merit and decide whether it would stay as is and just factor in the planning, or if it was liquid enough, it could transfer in. An example of where that's easy is with shares. If you had shares in your own personal name, they were tax-free prior to arrival. So moving them into the trust, you know, when you head back to Australia, doesn't trigger any tax issues. You can move it in there quickly and easily, and then it's in the best position moving forward. What I want to give you a quick look at is we have a very, very special tax planning modelling system in ATS to help you understand this very complicated situation and simplify it to your own situation. Now, I've got a very simplified version of it on screen for you, and I'm just using, for the sake of argument, a person that would have $2 million of investment capital, and hopefully that would be over and above their family home. So in a perfect world, you'd have bought your home, been able to pay cash for that, and still have some investable money. Now, obviously, some will have much less, some will have much more. I'm not trying to suggest that this is a necessary amount. I just want to show you the importance of asset selection and a little bit of tax planning and some thought when you're living in Australia. Now, up the top, I've got, if we had no tax planning and we were very conservative, if we put that money just on fixed deposit, right now it would make, unfortunately, only about 1.5%. So that would generate us $30,000 a year of income. And because it's a couple in this case, the tax on that would be zero. And the reason being is you can earn about $20,000 without paying tax. But the problem is $30,000 isn't enough to live. So, yes, it's nice and safe, it's in the bank, it's all happy, but I can't live off $30,000 even if I own my own house. Now, we want to chase income, but not at the expense of tax, and certainly not at the expense of adverse risk. So I've just done a very simplistic example that if you mix your portfolio up with a little bit of super, a little bit of investment property, a little bit of shares, a little bit of our syndicates, and a little bit of cash left over to fund you, you can see the revenue from that mix would be about $107,000 per annum. Now, the taxable portion of that is only $76,000. And the reason being is the superannuation pension, it's tax-free. The property has some depreciation allowances, and the shares come with a franking credit. Now, that franking credit increases your income, but is used to offset in full any tax payable. So in this case, that's $76,000 of taxable income based off $106,000 of physical cash income, gives a tax bill between the two of you of $9,300. But before you pay that $9,300, you've got the franking credit from the shares coming down to offset. So your actual tax payable on that $106,000 is only $1,233. Now, that's an effective tax rate of 1.15%. Now, I'm pretty sure that most of you would be content with 1.15%. And that gives you $105,000 after tax income to enjoy. Now, in this situation, we've paid cash for our house. So this is literally just available for, general expenses, traveling, enjoyment, hobbies, entertainment. And that's roughly what most people need. I've worked out that it costs roughly $50,000 to exist, plus your toys, plus your entertainment, plus your travel, plus your kids, and of course, plus your housing. In this case, we've got housing down to nil. But 1.15% tax is not bad. Now, the thing is, with very small amount of adjustment, we could get that $1,000 payable to actually become a refund just by getting a little bit more shares with a little bit more franking credit. And all of a sudden, it goes from a little bit payable to a little bit refundable. So you move to a zero tax environment. So we've got lots of ways that we can show you that even if you said $1,200 is too much for you, we can get that down and get you money back, particularly if you're in retirement. Now, this is also not factoring in things like carry forward losses on your previous rental properties, etc. And I don't factor those in the planning because they generally have a use by date. If you have been building up losses in the past, they will eventually disappear in the first year, 2 years, 3 years, or whatever. So I don't like to factor them in the planning because they're a bonus in the early years. If we did have $100,000 worth of tax losses, instead of $1,200 payable, we would get the $8,100 of imputation credit as a fully cash refundable amount. Now, importantly also, by having that mix of assets in property and shares, that also gives us the potential for some capital gains. The property hopefully can grow by, on average, 5%, but in these days, who knows? The shares can hopefully grow by 5%, but in these days, who knows? So there's the potential, but not assuredness, of also getting some capital gains. Now, what that does is puts another $48,000 of potential growth in value that you could live on or help the kids with or pay for emergencies along the way. Now, importantly, because that's a capital gain, only half of that $48,000 would ever be subject to tax. And you can see our tax rate in this particular situation, our taxable income is about $50,000 each. So our tax rate is still 32.5%. So on that 48,000, we'd only be paying on half, 24,000 at 30% is around about $7,000 tax on $48,000 of gains. So again, very, very nominal, very, very small. So we've got a net after-tax income and growth of around about $145,000 a year, which should give you a lot of confidence, a lot of buffer, particularly moving to retirement. Now, obviously, if you had income, if you had business, these things would have to be factored in because they can push your income up quite high and we need to factor those. But the good thing is our modeling is very, very complicated and detailed and it spits it out in very, very simple terms for you guys to understand. So whatever your value, whatever your investment capital, whatever your circumstances, we can just work it through and get you sorted so you know exactly what to do when you go home and exactly what your position will be and what you need to do to supplement it with working or not working, whatever the case may be. In finishing off, I just want to give you some of the simple secrets of success and make sure that you've got the right pathway to go forward on that. But the secret of success, the number one thing is very much awareness. Okay, it's critical that you have some level of awareness of what's going on around you. When do you intend to move back? Are you going to live in a current property or do you have to buy it? How much will that be? How much will the loan be to be paid off? Where is your income going to come from? How much do you need? These are very important questions. And again, that's what our modeling will help you go through. And we'll obviously be asking you these questions because these need to be considered. Now, there's no real issue whether you go home in July or June because you're only taxed from the point of arrival back. So you don't have to be concerned about that. But certainly you can see it would be a big difference in your share value if you went back in April this year when the market was down versus now when the market was up. So you'd want to have delayed your decision to go back and let it recover a bit so you have a higher entry point for capital gains. So be aware of the circumstances. Now, of course, COVID has changed this. Normally we were walking around in a daze thinking one day. COVID has brought this to roost for many of us. So hopefully it's got the conversation happening at your dinner table as to how long we're going to be overseas. Is it going to be our choice or not our choice? And you can work out what's best for you. But come along and we can help you answer those questions. You need factual knowledge. I mean, we've given you a lot of information in this presentation, but again, we've just tried to give you as much as you need to know. There's obviously a lot of underlying law that we have to go through, but you've got to get it from a reliable source. There's too many people that do hear whispers and whispers of convenience more than anything else. And if it suits you to hear something and agree with it because it works in your favor, that's dangerous. If you get caught out from lack of knowledge, you're in trouble later on. And again, the Australian tax system is not cheap when it comes to penalties for non-disclosure, etc. So make sure you seek out professional help. We're always here to do that for you. And you've got to look at it from a big picture strategy. Again, if you're living overseas, usually the only taxable thing you've got to worry about is your salary, and the rates are quite low and generous. In Australia, everything is taxable, so we've got to plan everything. Who's going to be the legal owner? How long are you going to do? What are you going to do when you exit? How are you going to fund it? We have to consider a lot of things, so make sure that you talk about that, and again, we'll help you through. And you've got to think in advance. You cannot be reactive with the Australian tax regime. You cannot say, oh, I didn't check, but I did this. Selling an asset in the wrong time, for instance, if you sold something within 12 months versus waiting for the 13th month, all of a sudden it goes from half tax-free to fully taxable. That could make a significant difference in your tax bill. So you want to be absolutely sure that you know what you're going to do before it starts, it's in the right name, and you've got a strategy so you know what to do if certain things happen. And review it as often as possible. And that's what we do with you. And of course, you want to use those tax incentives that the government has generously and willingly given to you. And they include things like the depreciation on the property, the franking credits on the shares, and the superannuation being tax-free. So take advantage of those, but don't be too single focused. You don't want to have one at the expense of the other. They all have a place, they all have a fit, and they all need to be considered in their entirety, not in their exclusivity. And probably to finish off, most importantly, you need to be very honest about yourself and your situation. You know, are you actually moving back or not? Have you got, you know, the willpower to save? Have you got the cost structure? Can you rein in your expenditure? You have to consider things very, very seriously, because there's usually no second bite of the cherry. You know, you want to make sure that you're going back after whatever time you spend abroad in the best situation possible, and you can have a continuation of what hopefully has been an exciting life abroad. You know, you don't want to go back and smash into a tax wall and all of a sudden be back living a life that you are not enjoying and wishing that you were overseas. And particularly in many industries, we don't know if and when those expatriate jobs are going to return. So you might be stuck in Australia for a long time. So far better, with a little bit of planning and a little bit of help, you go back happy, healthy, and financially strong and secure, than going back, you know, begrudgingly and angry that your party has come to an end. You know, if you're honest with us, you'll be fine. And you need to be honest with the tax office, because it is impossible to not declare. The world has got smaller and smaller through technology. So if you think you can hide money and the tax office will never find it, think again. They always will. It's inevitable. They track everything these days. So with good planning, you can get great results, and with great advice, you can get even better results. And of course, we're there to help you. I hope you found all of that to be of some level of assistance. You know, of course, we're there to help you. We've been doing it since '95 with, you know, thankfully the leading firm. And we've got that modeling tool, which is absolutely fantastic. It doesn't take a lot of time, so we can make it very affordable. It's an initial upfront cost and no ongoing charge. And, you know, it's available to all of you. I would, you know, absolutely compel you to consider it. We're always happy to discuss it with you, obligation free at the start, to show you how important it is, because it just takes the fear out of where you're going. And we want to remove that fear from your life and then work with you to get the best possible outcomes. You know, I really appreciate you tuning in. I'm sorry I can't be there in person, but we just can't fly anymore. You know, who would have thought? You know, and personally, me, addicted to flying, I'm struggling a bit, but I put the cement boots on here in Perth, you know, hiding out from COVID, and I can't get home to Singapore, but I'm looking forward to getting back face to face to seeing you sometime soon. Thanks, everybody, and I'll pass you back to Julie.
Thanks, Steve, again. It's been another really insightful seminar. If any of you still have questions or would like to take advantage of a free initial 20-minute consultation, please email smats@smats.net, or you can send inquiries to www.smats.net/inquiry, or feel free to respond to our email, julie@smats.net. So thank you so much. Have a lovely evening, and we will be in touch soon.